We've got Nitin Bhasin, Head of Institutional Equities at Ambit, joining in on the show right now. Nitin, hi, good morning. Good to have you on the show. Help us understand, while we've made up for all of those April 2nd, tariff announcement day losses, but what's the market looking like amidst just so much haze around tariffs to begin with?
Hi, good morning. Thanks for having me here. You're right. This year has turned out to be quite a roller coaster in the last month or two. Markets down, markets up. I think but what we are keeping an eye and speaking to our investors is, whilst the tape can be volatile, it's the earnings that we need to keep an eye on. FY25 earnings for India, Nifty was closer to about 8% growth, and it's one of the weakest numbers in the years. So perhaps we should be looking at what sort of companies or where do we actually land up in the earnings growth next year. So I think in all of this haze, earnings will be the reality that we all should follow for the good quality companies.
Uh,
Yeah.
how does one go about fixing asset allocation in this time then? Because one side you've got equities which are down, second side gold which is up, and third side bonds which are looking promising. Because if you sell equities now, you're selling late. If you sell gold right now, you may miss the best part. And if you go and buy bonds right now, well, then you're conserving capital.
Nikunj, interesting question. This is what we try to answer in the month of January and February when we put out our asset allocation framework. Since we're advising institutional investors and not individual, we kept gold out of it, and we still maintain that we prefer bonds over equity in the near term. And so that I would say for most of the mutual fund managers or large asset allocators, we would say for this year, it could be bonds over equity. I think the reason why I would say that on the equity is the valuations in India, haven't actually corrected that much, though the stock prices feel corrected in many stocks. That's number one. But at the same point in time, earnings outlook for us, for our team, doesn't look that promising. As I mentioned earlier to your colleague, after growing Nifty 8% earnings for FY25, the consensus earnings growth for next year also doesn't look anything better than about 9 to 11%. And a lot of dominance of either banks or IT sector, or for that matter, cyclicals, the global cyclicals. And in an environment like this where we are living in today, classically that, cyclicals or IT, global cyclicals or IT can disappoint. So the earnings growth is somewhere keeping us little, I would say, on the back foot when it compares to equities compared to bonds. So asset allocation, bonds over equity.
Right. Hi Nitin, good morning. This is Shrishti also joining in. So yes, of course, the risk is about the earnings growth slowdown. But amidst this, help us understand that which sectors are likely to outperform, because sectorally a lot's been happening, and with respect to the tariff as well as what we are getting to hear from RBI as well. So help us understand amidst this environment, which sectors could actually outperform.
Uh, for the last couple of months and actually a little longer period, we have maintained that when you look at the this year, it could be actually a stock pickers market, and within that, we prefer mega caps or large caps over mid caps and small caps. Well, that said, we still maintain that banks is somewhere, private sector banks is somewhere we would recommend investors to be overweight in. The first half of the next fiscal, or the current fiscal, which is FY26, we should see the peak stress when it comes to, let's say, the credit cycle. So I would say banks where the earnings is pretty much looking very stable, that could be one sector where we would be overweight. Number one. Number two, we could be actually overweight on FMCG. We've been highlighting this since the month of January and February, that FMCG, and more so now, what we're noticing is since the crude prices have come down, we are seeing the CPI to WPI spread again widen, which is a very good sign for the margins for the FMCG sector. So hence, for the next 6 months or so, we would also recommend FMCG being overweight. So those will be two classic overweights for us, one followed by a small overweight we've been highlighting in the healthcare space. IT, despite a lot of price correction, we don't find solace right now when it comes to either a growth acceleration or margin support and now the US perhaps growth slowdown risks. So that will remain one of the key underweights, or let's say not at anything better than equal weights for us. So I would say banks, FMCG, followed by healthcare. Those would be the three sectors of overweight for us.
I mean, they say that if you buy stocks at P multiple of 50, 60, पैसा नहीं बनता, right? That's a colloquial word in Mumbai. 70 के ऊपर बाबू पैसा नहीं बनेगा.
I didn't get that. Sorry.
No, they say that if you buy stocks above 50, 60 PE, you don't make money. I mean, isn't that the story for FMCG? P multiples are 50, 60, 70 times 1 year forward.
When we are looking at the markets right now, what we have to see is where is the less amount of earnings risk in terms of downgrades, or perhaps where there could be a possibility of earnings upgrades. So given where we see possibility of margins, given we see what are the positioning of most of the mutual funds, I would say relatively FMCG is something that we prefer, but at the same point in time, valuation starting points do matter. But as a sector, most of the sectors in India right now are trading very expensive. That's why FMCG is not our top most sector compared to banks, and banks is where earnings are there, earnings down risks are least, and the valuations are in your favor.
Let's look at a contra logic in IT. They're cheap, they have cash, and they keep on doing buybacks. And if one looks at the TCS numbers were not wow. I mean, nothing was blossoming in the numbers, but the stock did not fall. So are we nearing at the end of the pain for IT after this recent fall? Because stocks have also fallen 15, 20, 30% from the highs.
No, you're right that the stocks have corrected from the highs, but at the same point in time, our belief is that in the year where US growth could come under risk, barring BFSI, not many other sectors out there also are showing any trends which give us that the IT sector perhaps will not see more downgrades. I think we expect more earnings cuts. And if our earnings cuts estimates was to change, definitely I would say that one should actually start looking beyond the price cuts and start adding the sector. But today, given the risks looming large on them, perhaps at the best, not the best overweight right now. That's how I can conclude that the margin and growth risk, both looming large.
Okay. Where do you see bond yields will settle? Because they've already gone to almost a 3-year low. Is there still more juice left in the long bond trade now?
So, I would say that perhaps in the rate cuts, our belief earlier was limited rate cuts, but now given the rate cuts cycle, we think at least 2 more rate cuts should happen. And perhaps in the next month or two, first and then another 25 bips, at least 50 bips rate cuts should happen. And now we are moving from, let's say, constrained liquidity to more accommodative. You could see that the government or otherwise, given the growth prospects of India, sort of GDP level remaining closer to about 6.25%, there is a possibility that bond yields could go down. Another, I would say, anything between 30 bips to 50 bips possibility. So hence that could be the move in the bond yields leading to our bullishness on the bonds over equities in the near term.
Nitin, appreciate your time and thank you for joining us. Great to have your valuable inputs here.
If you like this video, then like, share and subscribe to ET Now.